Hey, future CPAs, if you're a Gen Z BS accountancy student gearing up to totally crush the FAR section of the LE CPA board exam, well, you are in the exact right place. Today's explainer is all about building what we call a 3-year memory palace. We know your board exams might be a few years away, right? So honestly, last-minute cramming just isn't going to work. We need pristine, distraction-free visual anchors to lock this theory into your long-term memory so it's there when you need it. Okay, let's dive right in.
So here's our roadmap for today. We're going to cover 1. The rulebooks, 2. Measurement principles, 3. Foundational assumptions, 4. Forms of business, and finally 5. A study hack review.
Section 1. The rulebooks, frameworks preventing financial chaos.
Imagine a world where every single company just made up their own rules for reporting profits. It would be absolute financial chaos, right? You wouldn't be able to trust anything. Well, these frameworks are literally the only thing standing between orderly financial markets and utter confusion. First up, we have GAAP, or Generally Accepted Accounting Principles. This is the common set of standards indicating exactly how to report economic events, and it's primarily used in the US. Think of GAAP as the original foundational language of accounting. It heavily influences global practices and sets a massive benchmark for the rest of the world.
And then we have the flip side, which is absolutely vital for us in the Philippines setup, IFRS, or International Financial Reporting Standards. These have been adopted by over 100 countries. And we actually adapt them here into PFRS, the Philippine Financial Reporting Standards, specifically to increase global comparability. As global markets strive toward international convergence, which basically means blending GAAP and IFRS into one unified giant rulebook, understanding this international perspective is an absolute non-negotiable for your board exams.
Now, to prevent these acronyms from just blurring together into alphabet soup over the next 2 or 3 years of your studies, I want you to take a mental photograph of this comparison right now. In the US, the SEC, the Securities and Exchange Commission, relies on the FASB, the Financial Accounting Standards Board, to actually develop their standards. But over on the international side, the rulemakers are the IASB, the International Accounting Standards Board. Here's a quick hack. Just connect the I in IFRS with the I in ISB. Boom, anchored in your brain.
Let's move to Section 2, Measurement Principles, Cost versus Fair Value Valuation.
Okay, so when a company buys an asset, what number do we actually write down on the books? We've got 2 main contenders, and understanding this trade-off is absolutely crucial. The cost principle, which you'll also hear called the historical cost principle, says you record assets at exactly what you paid for them. It is strictly factual. If you bought a piece of land for $300,000 and a year later the market says it's worth $400,000, under the cost principle, it stays locked at $300,000. It's faithful, it's objective. On the other hand, the fair value principle is all about relevance. It dictates that assets and liabilities should be reported at fair value, which is basically what you get if you sold it right this second. This is typically used for actively traded assets like investment securities, where that market price is right there and super relevant for decision-making.
Section 3, Foundational Assumptions, the invisible boundaries of accounting. If accounting is a sport, these assumptions draw the strict, invisible, out-of-bounds lines of what gets recorded and what just gets totally ignored. First up is the monetary unit assumption. This rule basically states that you only include transaction data capable of being expressed in money terms. It's the vital pillar that actually supports the cost principle we just talked about. This means if an event cannot be expressed in cold hard currency, like, say, the exceptional health of the company's owner, or how great the customer service is, or the soaring morale of your employees, it simply isn't recorded. You cannot put a solid peso or dollar amount on good vibes, so it stays entirely off the financial statements. Now, there is a totally crazy ethics note from our source material detailing the massive Adelphia scandal. We're talking about a company that guaranteed over $2 billion, yes, $2 billion with a B, of loans to the founding family. It perfectly, and honestly terribly, illustrates the absolute danger of blurring the lines between personal finances and company finances. And that exact scandal leads right into our second core rule, the economic entity assumption. This demands a strict, impenetrable wall between the activities of a business and its owners. If you own a boutique, your personal grocery bills or living costs are completely segregated from the boutique's actual business expenses. It really doesn't matter if it's a tiny corner sari-sari store or a massive giant like Coca-Cola, the economic entity must always stand alone. Section 4. Forms of business. Proprietorship, partnership, corporation. Stare at this matrix for a second.
Comparing proprietorships, partnerships, and corporations side by side like this is infinitely better for your brain than reading dense, boring textbook paragraphs. A proprietorship is owned by one person, a partnership by two or more, and a corporation by stockholders. But I really want you to focus on the liability row. Proprietorships and partnerships have unlimited personal liability. That means if the business goes under, creditors can literally come after the owner's personal assets. But a corporation, that has limited liability. And its life, it's unlimited because those ownership shares can just be transferred anytime.
Highlighting this specific quote directly from our source material is going to cement a highly tested LCPA concept. The holders of the shares enjoy limited liability, that is, they are not personally liable for the debts of the corporate entity. Think about it. If you invest in Apple or a huge local Philippine corporation and the company gets sued for billions, you only stand to lose your initial investment, not your personal house. That is the magic of the corporate structure, and trust me, it is a favorite trick question for examiners.
Section 5. Study Hack Review, Locking It into the Memory Palace.
Okay, we've covered a ton of ground today. Let's lock this all into your long-term memory with a quick active recall strategy. Just pause for a second and force your brain to mentally retrieve the information. What were the two measurement principles? Remember, one was strictly factual, one was market-based. And what were the two foundational assumptions we just covered? One involved money, the other involved a strict brick wall between the owner and the business. Got 'em? Let's check your answers.
Here are your visual anchors for part 1 of the review. We contrasted the US GAAP against the global IFRS. We paired up our standard setters. FASB works with the US SEC, while the ISAB handles international standards. Then we nailed down measurement. The cost principle prioritizes strictly factual historical data, while the fair value principle prioritizes up-to-date market relevance.
And here is part 2. Literally take a mental snapshot of this right now. The invisible boundaries of accounting. The monetary unit assumption dictates only things expressed in actual money make the cut. The economic entity assumption means the business and the owner are totally separate. And finally, business structures. Proprietorships and partnerships expose you to unlimited personal liability, whereas a corporation shields you with limited liability and enjoys an unlimited life.
As we wrap up this explainer and you continue prepping for your future board exams, I want to leave you with a massive what if. If the ultimate goal of the FASB and the IASB is total global convergence, meaning one single universal accounting language, how will that ultimately reshape the way you, as a future CPA, analyze financial data from Manila to New York to Tokyo? Really think about it. Keep analyzing, keep recalling, and you are going to absolutely crush your exams.